Hello friends, this is Macro Meow. I use macro views along with technical analysis for my trading. Here I am trying to offer simple views, simple explanation on the macro events that unfolded during the previous week. So let's see what happened during the previous week. Last week was characterized by two important things. One is the bank turmoil. The other one was the interest rate decisions by major developed market central banks. So there are three central banks: Federal Reserve, Swiss National Bank, and Bank of England, that raised rates while the banking turmoil was unfolding in front of us. So let's see what happened. First, let's start with the timeline, the last week's banking turmoil. So on March 10th, when the SVB bank problems became clear and came out in open, a California regulator shuttered SVB and appointed FDIC as the receiver. Bank stock section losses and regional lenders were hit the hardest. On March 12th, US government and Yellen says she is working closely with banking regulators to respond to the SVB collapse. And later, US officials say SVB customers will have access to the deposit. Basically, they bailed out the failed SVB bank, and they said all the depositors, whether they are insured or uninsured, will have their deposits back in full. And on the same day, New York State Department took possession of another failed bank in US, that is Signature Bank. As usual, like in Indian movies, when the police arrives after the climax, the Moody's and other rating agencies came back and they said they're revising the outlook for US banking system to negative from stable, citing heightened risk. This was 2 days after couple of banks failed, and the US government was forced to rescue the depositors. And the contagion, the banking turmoil contagion, spread to Europe. On March 15th, troubled US bank, Swiss bank giant Credit Suisse already had issues, had a lot of losses, and depositors were withdrawing funds in billions. Its problem came out in open on March 15, and they openly asked for Swiss National Bank to come out and say something in support of them for, to calm the nerves of the depositors. So Swiss National Bank offered 50 billion Swiss francs, a loan facility which Credit Suisse readily availed. And on March 16, Yellen said something which was kind of reversing her earlier commitments to the depositors. She said uninsured deposits would only be guaranteed if it is deemed a contagion risk, meaning only if the big banks, the systematically important banks fail, they will help the depositors. Otherwise, they won't help the depositors. This caused some kind of uncomfort, and depositors started withdrawing funds from a lot of regional banks. And again, contagion started spreading further. And then again, large banks such as Citibank, Bank of America, and Wells Fargo put together an emergency 30 billion deposits, and they placed a deposit in the another troubled First Republic Bank just to show some confidence to the depositors. And March 18th, the Swiss bank managed to get UBS take over the troubled giant Credit Suisse. Swiss government had to offer securities, guarantees, and also undertake to refinance for 5 billion francs. There is going to be a loss due to Credit Suisse takeover. And as the banking turmoil showed no sign of stopping, on March 21st, Janet Yellen again reversed her earlier position and said she is prepared to intervene in any smaller banks to protect depositors. That offered some sort of comfort to the market. But last Friday, that is yesterday, European banks started having trouble in the market. The bank shares crashed and the 81 bonds, the Tyrone bonds started falling off. The credit swap, default swap has started to rise, meaning the insurance against the bank failures to pay those 81 bonds spiked. And also the banks started showing signs of stress in the market. Every other bank stocks were slumping. But in the meantime, as the banking turmoil was unfolding and contagion was spreading, Federal Reserve raised the interest rates by a quarter percentage point as expected, and they voiced confidence in financial system stability. However, there is a general view that banks either hit with sudden deposit outflows or worried about them may become steadily more reluctant to lend to businesses and households. This will sharply slow down the economy, and also you create problems for businesses who depend on bank finances for their working capital or their immediate financing needs. So when the bank turmoil was unfolding, Federal Reserve increased the rate, and they're confident. But were they really confident? Because market, for the first time in a year, Federal Reserve has left its next policy step in doubt as officials weigh the risk of continued high inflation against possibly looming US credit crunch. The credit crunch is basically banks and other financial institutions stopping the cash flow in the economy by limiting the loans, limiting the working capital finances, because banks are facing their own problem and depositors are withdrawing billions of dollars. So, how are they going to manage their loan book? How are they going to further fund the businesses and households if they don't have the deposit support? So that is why the Federal Reserve Chairman Powell said, it's really a question of not knowing at this point. This is a problem for markets. Markets hate uncertainty. Markets want certainty from the policymakers, from the government. They want to foresee the future. Although it is impossible to know the future, at least they want to guess the future with certain amount of certainty. When the central bank of a powerful nation like Federal Reserve say, it's a question of not moving at the point it increases uncertainty in the market and market continue to fall down. But why the Federal Reserve is uncertain? Why is it not sure about what to do next? That is because Federal Reserve is facing a twin problem, just like they are in between a devil and the deep sea. They have a running away inflation which is not coming down, destroying the people's monthly budget. And also they have uh, another big problem of banks on the verge of failing. The banks, because they had huge bonds that has lost bond holding, which has lost value over the last 1 year because Federal Reserve increased rates, are facing an existential threat. Many banks may fail. So the Federal Reserve does not know to continue to raise rates to slay the inflation or just save the bank that will cause inflation to rise further because they will have to add more liquidity, more funds in the system. So that's what the Bloomberg says. In 140 years, American policymakers have never faced a banking crisis quite like this. Generally, when the inflation runs high, it is always a situation where the economy is doing well, banks are strong, and the central banks are at their liberty to raise interest rates to cool the inflation. But in this case, the rising inflation is also threatening the banking system, and banks are failing. So they haven't faced this kind of crisis in the history of a Federal Reserve or any other central bank. So this uncertainty in the central bank has also led to the market narrative fluctuating between two extremes. For example, Double Lines Kunlak predicts Federal Reserve will cut rates substantially soon. The Federal Reserve will substantially cut rates only when there is a major problem for the economy. When the last time Federal Reserve cut the rate substantially was during the global financial crisis and during the COVID pandemic. On these occasions, economy was almost falling off the cliff and they had to stop it. Therefore, they had to drop the rates drastically. So what Kinlock means is that the economy is on the verge of falling, crashing down. It's going to fall off the cliff. So it's a negative prediction about the future. So that's what Kinlock expects Federal Reserve will cut rates substantially soon. However, Goldman Sachs says Federal Reserve and ECB will each hike 50 basis points further from here. That is a mark of confidence on economy because the Federal Reserve or the central banks will continue to focus on inflation and raise rates only if they feel the economy is strong and it is not going to be a problem, system-wide problem. So the market narrative is diverging between very pessimistic economy is going to fall off the cliff prediction to no, economy is still strong and central banks will continue to raise rates. So with all this global events and banking turmoil unfolding in global arena, what's happening in India? Is Indian banks stronger or is the contagion going to spread to India and cause economic hardships? The RBI, in its March 2023 bulletin, states they optimistic, remain resilient amidst high tides of uncertainty. Indian economy has remained resilient, and that unlike global economy, India would not slow down. It would maintain the pace of expansion. So they're confident that economy is growing and staying its course of growth. At the same time, RBI is also worried about high inflation. The consumer price inflation in India remained high, while core inflation defied to reflect the softening of various input costs. The core inflation is the inflation where the fuel cost and the food cost is not considered because these two tend to fluctuate often. But the core inflation is also not reflecting the reduction in raw material cost, reduction in crude oil prices, and other input costs. So they're saying the core inflation is getting entrenched, meaning people are getting used to the higher inflation. Business are comfortable charging higher prices. So this is an issue, and RBI is worried about that. What does this mean? It means RBI is confident about the economic growth. India is sustaining its economic growth, and they're worried about the higher core inflation, which means they are going to continue to raise rates and till at least the inflation moderates. So there's going to be further increases in rates. And are they all very confident? And apart from this mark of confidence and you know publicly talking about resilience of Indian economy, the government is also worried about the banking contagion spreading to India because many banks, especially public sector banks, have large holdings of government bonds. They bought these bonds when the bonds were at high, all-time high kind of situation because rates were low and bonds were priced very high. But in the past 6 months, 3 months, the bond prices have crashed. So they are holding mark to market losses in their books, in their bond portfolio, in their treasury portfolio. So obviously, government is worried how deep their losses are, how deep their holes are, because the SVB bank in US collapsed because of the same situation. They held US treasury bonds that they bought at high, but when the treasury bonds fell, crashed, they had mark-to-market losses, and the investors and depositors got worried and they started withdrawing funds. But the same situation happened in India. The government of India is really worried, so they're asking for details and see how big the hole is in their books. So apart from checking out with the banks, they're also trying to help banks with deposits. India proposed to remove long-term tax benefits for debt mutual funds. That is, mutual funds with less than 35% invested in equity will be treated as short-term, and indexation benefits will not be available. So why are they doing this? This could reduce inflows into debt mutual funds. Obviously, people are not happy with higher taxes. They're not going to continue to subscribe or buy these debt mutual funds. Instead, they'll go back into bank deposits. So the government is obviously worried about the deposit situation and mark-to-market losses of the banks because of bond prices have risen. So they're trying to shore up the bank deposit, help banks by raising tax on debt mutual funds. So with all this macro situation playing out the last week, how did these events affect Indian markets? Indian markets, after touching 18,800 here, they were on a down move, was 17,000. The up move started from 16,800 after reaching 18,800. The market is in a down move. But during the last week, the previous Friday, market capped down due to SVB bank troubles. Then on 21st March, Yellen says prepared to intervene to protect depositors. That offered a little bit of comfort, and market went up for 2 days. Now, after the gap down, it crashed through this immediate support at 17,250 and went to the next support level of 16,800. Then US government assured investors that they will take care of depositors and they are determined to control the contagion and banking crisis. So the market went up for 2 days, but again on Friday, the market Nifty crashed, and that is because when European market opened, the banking shares collapsed, and European banks such as Deutsche Bank, uh, were losing confidence in market. Their AT1 bonds were falling, and the shares were crashing. The contagion was spreading. So by late Friday, Deutsche Bank tried to calm the nerves and say they will redeem the AT1 bonds that is maturing in 2028 immediately, totaling about 1.5 billion euro. This was done to shore up the confidence in markets, after which market retraced in Europe and US a bit. So this is how the market reacted to the major macroeconomics events of the last week. And thanks for watching. In my next video, I'll talk about the macro situation and unfolding currently and how that is going to affect the Indian markets the next week. Thank you once again. Bye.